Hi everybody, welcome back to Basic Business Finance. I'm Erin Geibel again. Today we're going to be talking about the second of two of the financial scorecards, the income statement. This is also referred to as the P&L or the profit and loss. In any term or sense, what it shows you is what your company made for a certain period of time. When we think back to that football example we used when we talked about the balance sheet, all of the activity, the playing going on, the quarterback throwing, the players running, tackling, crashing into each other, somebody crossing the end zone, getting tackled, getting up, celebrating. All of the activity is what gets recorded and summarized in this income statement. Different from the balance sheet because it is not one snapshot in time of what the company looks like. It's a summary of everything the company did to get to where it's at. Simply put, the income statement shows you that your revenue less your expense gives you your profit. So everything you made shows you where all that money was made minus everything you spent. It shows you where all that money was spent, and it shows you what was left over after all of that happened. With the income statement, it is very important to remember that timing matters. We talked earlier about cash accounting versus accrual accounting, and that will come into big play here to the result of your income statement, especially if you're a company with inventory, as our example, that bakery again, shows us. If you sold something in a period but didn't get cash for it until later, that income statement is going to look a whole lot different than one where you sold something and recorded that you expected to get cash, whether you got it a month later, week later, even a year later. So timing is important on this income statement. Also, talking about that accrual-based accounting, you need to record income exactly when it happens. So this is when timing, is it the last day of the month? Is it the first day of the next month? It starts to matter depending on how close you're looking at this statement and what exactly you want to get out of it. So we're going to look now at a simplified version of an income statement, back to Sweet Treats Bakery, where you have your revenue minus your expense, gives you a profit, less your other depreciation and taxes, gives you another profit. The reason these depreciation and taxes are a separate line is, especially as a manager or an owner, that's something you can affect probably less than all of your other expenses. So really, that $36,000 in this example is the number you're going to be focusing on and really trying to analyze and improve. An income statement is no different for a company as it is in our personal lives. If you think about it, everybody has a paycheck. Everybody has some source of income. That's your revenue. Everybody also has expenses. Everyone has groceries they pay for, maybe utilities, maybe rent or a mortgage. All of those other things are your expenses. They decrease your revenue. And then your income, what's left over, is your profit, your play money, your fun money in the end. So really, personal lives, company, not too much different. As a manager or an owner, you're definitely going to want to look in a little deeper of what's in those categories. Again, when we look at the top, your revenue, a lot of places will have more than one type of revenue. Sweet Treats Bakery here decided to sum it all up in one line, but they could have divided it out. Maybe they do some catering, maybe they do some storefront sales. They could have had a couple different lines for revenue. They don't. Maybe your company does, maybe it doesn't. Next is your expenses. You're going to have two main types of expenses. You'll have your direct expenses here on the top, and those are the things you couldn't get away with without having. To produce that revenue, you need these exact things. Maybe pricing can fluctuate, maybe payroll can fluctuate, sure. But all of those things are key to producing that revenue. The second are your indirect expenses. Usually those are things you need too, but they're a little less related to the revenue. Those would be things such as rent, leases, stuff you absolutely need to run a company, but maybe not to produce that exact cupcake or that exact loaf of bread. They're all your operating things your business, your company physically needs, but not directly your profit. Service companies' income statements will look a little different than this. They may have less direct expenses up here because they don't have inventory, they don't have ingredients, those types of things. But they probably do still have labor and, a couple other things to produce that direct line of revenue. After that, you have, well, within your operating expenses, you have your design or engineering, you can have sales and marketing. Just about every single company is going to have some general and administrative. That's just the salary of your owner, or that's your accounting department, your maintenance department, those types of things. So, revenue, you have direct expenses that relate directly to your product. You have indirect expenses that your company couldn't run without, but may not match as directly to the goods or services you produced. And that gives you this operating income. Don't be frightened by all those EBITDA letters you see there. You may have even heard that term called EBITDA. All that means, and all that we're going to refer to it to and throughout these lessons, is operating income. That's that money that you as a manager could and should be able to affect that you keep from your revenue. So all your revenue minus those expenses gives you the money you made. After that is your depreciation expense, your income taxes, yada yada, to give you your net income or loss, what in the end you really walked away with or really still hold within the company. I do want to back up here and mention a little bit about depreciation expense, because that's something kind of overlooked. Depreciation, if you will, is the cost of having those assets that we talked about on your balance sheet for a certain period of time. Depreciation, I used to refer to this in some of my other trainings, is similar to rent. It's something you keep paying, keep the cost you have to have those. But really what it is doing is decreasing your assets because they do wear out, they get used up over time, and it is costing you something to have that piece of equipment, to have that, in this case, oven or cash register for that period of time. Someday you'll have to replace those. So again, that's going to be big cash out the door, which we don't see on this. We show it incrementally, period over period. There are, really quickly, I do want to mention different ways to calculate depreciation expense. Your accountant or accounting system will have more of those examples and probably know the best way for your company. But it's important for you as a manager to understand that there are different ways in doing so, in which you can take more or less of that expense in a certain period of time based on the life or the availability, the usage of your asset, of your oven, of your building, of your car. So keep that in mind. Again, something to talk about with your accountant to make sure you're reporting things as accurately as they should be for your business. So looking at this again, we mentioned before that all of these accounts will be found on your chart of accounts, which is something your accountant or system tracks, but they are adjustable for your particular company based on what you want to track, what you want to analyze. So this cookie company must pay big attention to their cookie packaging, because they decided to list that out as a separate expense, a very specific expense among all these other things. So they'll have the processes and controls in place to track those numbers and make sure they get into that financial line. But they've worked with their accountant and or system to make sure that's something they manage, something they control. They could have a lot more lines, a lot more different expenses on here, and my guess is that they probably do have a little more detail of some of these somewhere. They're just not reporting on it in their income statement. And that's another thing you can work on as a manager. How much do you want to track and have your accounting system record versus how much shows up on this income statement and For different departments, for different areas, you can have different levels of detail. That's usually not a problem. Important thing is to know you can, to decide what you want to track, and to work with your system or your person in charge of that to track what you need as a manager to best analyze your area. So we're going to go ahead now and take a look at Home Depot's income statement. Just to show you here that it's not too different than the simplified Sweet Treats Bakery we looked at. Here's the Home Depot here. Again, we're at morningstar.com, the same site we used for the balance sheet. They show here different periods across the top, and down the side those different categories and accounts we just talked about. I start with revenue up here. Cost of revenue, that would be, again, the direct expenses we mentioned, those things that couldn't have made money without. Then their operating expenses, the less direct ones, but think of it as the expenses their company, the business, physical business itself, needs to operate to give them a total operating income. They have some interest expense and some other things before they get down to their net here per period. So again, even huge companies such as Home Depot, you could pull this up for, whatever publicly traded company you want. No different than the basics we want to look at and go through in our smaller companies. Your revenue, less those direct costs of doing business, minus your indirect expenses that you couldn't get away without having, to give you your net income. So that's it in a nutshell. Thank you for joining us today, and we will talk again soon.